Hello again, I'm Cory Bannister and welcome to this special follow-up edition of LTF Product Showcase featuring commercial self-managed super fund lending. If you're joining us for the first time, you may wish to click on the link to view part 1 of this showcase series, which explores the features of commercial self-managed super fund lending and explains why you may want to get involved. We decided to bring you this follow-up piece following the great feedback we received from brokers excited about trying their hand at commercial self-managed super fund lending for the first time, many of which have already commenced marketing this product to their existing client lists as we suggested, and I'm pleased to report we've actually already received and approved an application from a first-time user of a commercial self-managed super fund loan product following our previous feature. Congratulations. Today we're going to address one of the common questions many brokers had in response to our feature, which relates to the future of self-managed super fund lending following the release in December 2014 of the David Murray-led Financial System Inquiry Report, part of which recommended that superannuation funds are again prohibited from borrowing using a limited recourse borrowing arrangement, or LRBA. This would simply mean that if adopted, self-managed super fund lending would no longer be available in the current format we have today, and consumers would be required to fund the full purchase price for any property they wish to acquire as an investment via their self-managed super fund. Now, you may be asking why the FSI would make such a recommendation. Well, the panel's concern in part relates to the rapid upward trend of superannuation funds using LRBAs to purchase assets, an 18-fold increase over the past 5 years. Increasing from $497 million in June 2009 to $8.7 billion in June 2014. There are now more than 500,000 self-managed super funds in operation according to the ATO, and it's estimated that the value of self-managed super funds will have grown to $2.23 trillion by 2033. The panel argues that investors have other ways of leveraging to purchase investment assets outside superannuation, as opposed to putting their retirement savings at risk. However, with the housing affordability in this country becoming a greater issue, finding other ways may not be so easy. Diversification of assets within self-managed super funds was also raised as a point requiring addressing, the panel concluding that superannuation funds use diversification to reduce risk, whereas smaller funds that borrow are likely to have a more concentrated asset mix. However, when looking at the data supplied by APRA and the ATO, it appears as though self-managed super funds currently have sufficient levels of diversification when compared to APRA-regulated funds. The FSI also raised lenders charging higher rates for self-managed super fund loans due to their limited recourse nature. Now, I can only speak for Trobe Financial, and I'm happy to report that our commercial SMSF loans currently attract the same interest rate as our traditional commercial products on offer. So what is the future of self-managed super fund lending? Well, here's my view. I'd be surprised if the government adopts the recommendation to prohibit direct borrowing by superannuation funds and believe that banning LRBAs goes against the fundamental principles of being able to self-manage your superannuation fund. It's your retirement nest egg at the end of the day, therefore you should be able to choose how you manage it. And property is an asset class that most Australians are comfortable with. We understand it, which is a much safer outcome than allowing punters to invest in asset classes they aren't as familiar with. However, if the government chooses to adopt Recommendation 8, small to medium businesses are likely to be the hardest hit, as borrowing through a self-managed super fund has allowed thousands of business owners to purchase the property from which they operate their business, taking advantage of the beneficial tax structure a self-managed super fund affords. Rather than prohibiting direct borrowing by superannuation funds, there are a number of options the government should consider to mitigate the risks raised, if indeed they feel compelled to act at all, such as introducing a limit on leverage within a self-managed super fund. They could introduce a limit on the maximum amount of leverage per asset within a self-managed super fund. Introducing limits on the asset class mix to ensure diversification, and they could remove the ability for self-managed super funds to borrow from related parties. There is still time before a course of action is likely to be taken by government, and I don't believe they'll ban direct borrowing entirely. So it is still, in my opinion, a very worthwhile product to pursue for brokers, particularly in the short term, as I expect the media hype that is creating uncertainty around this very issue likely to spur a mini property boom of sorts in self-managed super fund property investment, as business owners and investors look to take the chance to leap through what may be a closing window of opportunity, and as brokers, you may wish to do the same. Well, that concludes today's special follow-up edition of LTF Product Showcase. We thank you again for investing your time and thank you for engaging with us. We hope you found it to be of value. Until next time, best of luck with your business.